Hello, everyone. It is my hope that you are all doing well and keeping safe in the midst of the current pandemic. Please bear with me. I know it has been a long time since we had a meeting. Welcome to the third lesson of financial statement analysis, that is common size financial statements. So, common size financial statements is one of the major tools of doing financial statement analysis. One of the main aims of doing a financial statement analysis is to help in comparison. That is to compare the financial performance and financial status of a company historically and both cross-sectionally. By historically, I mean doing a trend analysis so as to compare the financial performance and financial statements status of a company over time, so as to be able to give a trend, to tell to so as to be able also to give to tell a trend and to be able to answer whether a company has been growing in performance or declining in performance or otherwise. So trend analysis or historical analysis. The other form of comparison is to do a cross-sectional analysis. In a cross-sectional analysis, we compare the financial performance and financial status of a company against other companies, say in an industry or in an economy. Common size financial statements come in also to serve this objective, the objective of comparison, to help in historical comparison and also to help in a cross-sectional comparison. Common sense financial statement achieves this aim by converting or expressing each item in a financial statement as a percentage of a base item. Yeah. So common sense financial statements, what they do is that we express or we convert each item in a financial statement as a percentage of a common base or a common reference item. So we can do a common size financial statement of both the financial statement of financial position, also known as a balance sheet, and we can also do a common size financial statement for the income statement, which is also known as the trading and the profit and loss account. By doing a common size financial statement, we derive ratios. Yeah, so the ratios are obtained when we convert each item in the financial statement to a percentage of a base item. So common size financial statements derives ratios which are used to compare the financial statements of different companies or of the same company over different periods. So the formula of obtaining a common size ratio is equal to the item of interest or the item in the financial statement divided by the reference item or the base item. So for instance, the common size ratio for inventory is equal to inventory over total assets. So in which case, inventory is the item of interest and the total assets is the reference item, also known as the base item. So we've said that you can prepare common size financial statements for both the income statement and the balance sheet. So when we prepare the common size financial statement for the income statement, which will also be known as a common size income statement, each item in the financial statement is expressed as a percentage of sales. Yeah. So for the income statement, the common size ratios are expressed as a percentage of total sales. So for instance, if we are to do a common size ratio for gross profit, we shall divide it by sales like that. So please note that for the income statement, each item is converted to a percentage of sales. Or we can say that for the income statement, each item is expressed as a percentage of sales revenue. Whereas for the balance sheet, we can also prepare a common size financial statement for the balance sheet. To prepare a common size statement for the balance sheet, also known as a common size balance sheet, we express each item as a percentage of total assets. Or rather, we can say that we convert each item in the balance sheet to be a percentage of total assets. So the common base for the balance sheet is total assets, whereas the common base for the income statement is the sales. So you have this table here as a summary for doing the common size ratios, both for the income statement and the balance sheet. And the common base is as highlighted there. The common base for income statement is sales, and the common base for the balance sheet is total assets. So we can have an example to illustrate that. So a common size income statement. So in this case, a common size income statement is, we have all the items in the income statement expressed as a percentage of total sales. So for instance, we have as highlighted there, so as I've highlighted there, we have the income statement, whereby we have the revenue, the cost of goods sold, the gross profit, the expenses, operating income, the interest expense, and the net income at the end. And then we have this column for the common size financial statements. So if you look at these these items in the common size income statement, in this column, you see that they are all in percentages. So these percentages are obtained by dividing each item by the total revenue multiplied by 100. So for instance, for revenue, this 100% is equal to 70,134, that is the item of interest, divided by the common base for the income statement, that is revenue, which is 70,000 divided 134, which will give us 100%. So the 100% is obtained that way. For the cost of sales, we find that we have the common size ratio is 63.1%, which is obtained by dividing 44,221 divided by 70,134 to obtain 63. So in this case, the reference item is cost of goods sold, and the common base is still revenue, that is 70,134. So if you do 44 divided by 70, 44 divided by 70, you get 63.1%. For gross profit, the common size ratio is 36.9%, which is equal to 25,913 divided by 70,134. It will give us 36.9. The same case with SGA expense, whose ratio is 19.3%, which is also equal to the reference item divided by base item. The reference item here divided by the common base, which is in this case is 13,531 divided by 70,134. Most probably it will give us 19.3%. And then the same case with operating income, the common ratio is 17.3%, which is the same, which is equal to 12,382 divided by the common base, which is 70.134. And the same applies to all the items in the income statement. Yeah. So the common size income statement basically expresses each item in the income statement as a percentage of the sales revenue, or sales revenue as the base item. So yeah, so that is the income statement. Then we move on to the balance sheet. For the balance sheet, the common size percentages are referenced to total assets, as we had said earlier. Yeah, so the common base for the balance sheet is the total assets. So the following sample balance sheet shows the dollar amounts and the common size ratios. So we have this as a common size. So as highlighted there, we have the balance sheet. So in that column, we have the balance sheet, the highlighted column, and then that highlighted comma, we have the common size balance sheet, whereby each item is expressed as a percentage of a common base, in which case for balance sheet, the common base is total assets. And that's why you find that the total assets are 100%, because it's expressed as a percentage of itself. And then everything else inside here, in this highlighted column, is a percentage of the total assets. So for instance, the cash and marketable securities To get the common size ratio of cash and marketable securities, you divide the cash and marketable securities by total assets. So in which case, the total asset is the common base in the balance sheet. So 15.51 is derived by dividing 66,029 shillings by 39,985. It will give us 15.1%. The same case for accounts receivable, the common size ratio is 36.0%, which is equal to 14,378 divided by 39,985. The same case with inventory, the common size ratio is 42.9%, which is the same equal to inventory divided by total assets. That is 17,136 divided by 39,985 to give us 42.9%. The same case with total current assets. The ratio is 93.9%, which is equal to total current assets divided by total assets, which is the same as that 7.543 divided by 39,985. It will give us 93.9%. And the same case with plant and equipment, the ratio is 6.1%, which is equal to total assets divided by property, plant and equipment. That is 2,442 divided by 39,985, which will give us 6.1%. And for total assets, the ratio is 100% because it's a matter of dividing the total assets by the common base, which is still the total assets, which will be 1. 1 times 100 will give us 100%. And the same applies to to the liability side. We divide each item by the total assets. Like say for example, for current liabilities, the ratio is 35.6%, which is derived by dividing current liabilities by total assets. That is 14,251 divided by 39,985. It will give us 35.6. The same case with long-term debt. The common size ratio is that 1.6%, which is equal to 12,624 divided by 39,985, which will give us that 1.6. So, and the same applies to all these items. Yeah. So for balance sheet, well, the common base or the reference item is the total assets, whereas for the income statement, the common base is the sales. So that is it with common sense financial statements. It has been a very easy topic. I don't expect you to, to not understand this topic. So common sense financial statements can be used to analyze financial statements. It's quite helpful to the users of financial statements to compare one company against others in the industry that is doing a cross-sectional analysis. So you compare a company against other at a particular point in time so that you're able to tell which company is doing better than which. So in terms of financial performance and the financial status of the financial position. So the common sense financial statements can also be used for a trend analysis to compare historical data of a company over time so as to be able to identify a trend, to see whether the company is improving or is declining, so as to be able to make some decisions, say for the managers, to make some decisions so as to correct a negative trend, so as to ensure that the company is doing well in the future. So the common size financial statements can be used for trend analysis, just like I've been saying. Yeah, it can be used to do what? The ratios in common size statements tend to have less variation than absolute values themselves, and trends in the ratios can reveal important changes in the business. So historical comparisons can be made in a time series analysis to identify trends, and common sense financial statements help in achieving this objective of doing a trend analysis, of comparing historical data of a company over time, so as to gauge the performance of the company over time, so as to help the management to do some control activities to ensure that the company reverts the right path, the path of growth. Common sense financial statements can also be used for cross-sectional analysis. In a cross-sectional analysis, you compare the performance and financial position of a business against other companies. So you list many companies together at a particular point in time. So as to compare the performance of each against the others, so as to be able to identify which company is doing better than which one. So common sense financial statements help in that objective of comparing between companies. That is a common sense that is a cross-sectional analysis, and it can also be used for a trend analysis. So we shall have another example. Of common sense financial statements. Please bear with me. Another example of a common sense financial statement. So you can do this together. So we have these financial statements. So we can prepare the common size of this statement. So we have K&L Fashions. I have K&L Fashions Limited. K&L Fashions Limited. We have the income statement. We also have the balance sheet. So we have the income statement for the year 2005, 2004, 2003, and 2002. So you can prepare the common size income statement of K&K. So let's try and do it. So K&L common size, common size income statements. Yeah, for the year ended 31st January. So this is a good example of a trend analysis. We are comparing the performance of a business over time. So that is from the year 2005, from the year 2002 to the year 2005. So can copy these items to here to our solution. So now here we can do a common size financial statement of the K&L Fashions Incorporated. So for the income statement, we say that the base item or the reference item is the net sales. So it shall therefore divide all of these items by sales to get the common size income statement. So in that case, using my Excel, applying the formula for the net sales, the ratio is usually 100%. For the net sales, the ratio will usually be 100% because you are dividing net sales against itself. Because the common base is usually for the income statement is the sales. So therefore, the base item for sales is 100%. For cost of goods sold, we divide 3573 divided by 6,039,000. So in that case, we take 3.573 divided by net sales, that is 6 million, gives us 59%. And then the common ratio for gross profit will be equal to the gross profit divided by net sales. That is 2.46 million divided by 6 million, which is equal to 2.46 divided by 6 million will give us 41%. So that the 41% is the common size ratio of gross profit for the year 2005. And then for selling and general expenses, the common size ratio is equal to the selling and general and administrative expenses divided by the net sales. That is 2.221 divided by 6 million, which is equal to 2.221, divided by 6 million. The common size ratio of selling and general expenses is at 7%. And then for incomes from operations, 245,140,000, the ratio shall be equal to the income from operations divided by net sales. which is equal to 245, 140 divided by 6039, which gives us 44%. And then interest and other income, that is 14,470 yeah, so for the ratio for the income and other expenses shall be equal to the interest income divided by the net sales, which is equal to 14,470 divided by net sales, that is 6 million. That gives us 0 point something percent, but rounding off it will give us a 0%. And then for the interest expense ratio, it shall be equal to the interest expense divided by the net sales. That is negative 10,000 divided by 6 million, which is equal to negative 10 divided by 6 million, still a negative of 0%. But that is that it has been rounded off. So before rounding off, it must be something like, let me see, must be something like that, 0.24 and negative 0.169. Then the common size ratio for interest before income taxes is equal, it shall be equal to the income before taxes divided by net sales. That is 249 divided by 6 million, which will give us 249,000 divided by 6 million, gives us 4%. And then for the income tax provision, we also divide it by the net sales, which is 102,000 divided by 6 million. So as easy as that. So the common size financial statements are quite easy to do. Then for the net income, common size ratio for the net income in the year 2005 is net income divided by the net sales. That is 147,000 divided by 6 million, which will give us 147 divided by 6 million, which is 2%. And we do the same for all the other years, that is the year 2004, 2003, and 2002. Since I'm using my Excel, I'm just going to autofill this, and it gives us those common sense financial ratios. So these ones will help us give a trend. Now we can easily see how the cost of goods, say for instance, have been performing, yeah, over the years. So from the year 2002, we can easily see that there is a growth. There's an increase in growth in the cost of sales. Yeah, the inefficiencies are somehow increasing over time. So the business ought to work on minimizing the cost of sales. Yeah, so which is affecting the gross profit ratio. Over the years, you see the gross profit has declined over time because of the inefficiency that we can see from the cost of sales. Yeah, so the financial statements, the common sense financial statements can also be done well for a trend analysis as well as for a common size analysis. So as easy as that. And then for the common size balance sheet, the base item for the balance sheet is the total assets. So every item will be expressed as a percentage of the total assets. So the total assets ratio will be 100%. So we can try and do that for the KE fashions, KL fashions. So the KL fashions, we can do the common sense balance sheet of KL fashions. So KL fashions, common size balance sheet. Common size balance sheet of KL fashion. So here we express each item as a percentage of sales, as a percentage of the total assets. So for instance, let me work on the asset side. So I copy the particulars here. So every item here is converted as a percentage of total assets. The total assets is a common base for the balance sheet. So for instance, for the cash and cash equivalents, the common ratio for cash and cash equivalents shall be equal to cash and cash equivalents divided by total assets, which will be equal to 272,000 divided by 1.854 to give us 15%. Then for the receivables, common size ratio is equal to the receivables divided by the total assets. That is 1290 divided by 1 million, which will give us 12,090 divided by 1.8 million gives us 1%. Then for the inventory, common size ratio for inventory, this case is 700 and it will be equal to the inventory divided by the total assets. That is 738, 630 divided by the total assets, that is 1.8 million. It will give us what? To give us 738 divided by 1.8 million, 40%. Then for the prepaid expenses, the common size ratio for prepaid expenses shall be equal to prepaid expenses divided by the total assets, which is equal to 54,880 divided by 1.8 million, which is equal to 54,880 divided by 1.8 million, 3%. Then for the total assets, the common size ratio for total assets is equal to 1078 divided by 1854. That is total current assets divided by the total assets, which is equal to 1078 divided by 1854, which gives us 58%. And then for fixed assets, the common size ratio for land and buildings is equal to land and buildings divided by total assets, which is equal to 531,270 divided by 1.8 million, which is equal to 531 divided by 1854, gives us 29%. For fixtures and fittings, the common size ratio is fixtures and fittings divided by total assets, that is 476 divided by 1.854, which give us 476 divided by 1854 gives us 26%. Then leasehold improvements, common size ratio for leasehold is leasehold improvements divided by total assets, that is 16,460 divided by 1.854, which give us 16,460 divided by 1.854, it gives us 1%. For construction in progress, we have a 0, we have dash as we have shown there, so 0%. Then we have less accumulated depreciation, negative 248. So the ratio for accumulated depreciation, it shall be equal to the accumulated depreciation divided by the total assets, which will give us negative 248 divided by 1854, which gives us 13%. And then the total of fixed assets, that is 775,760. So the ratio for total fixed assets shall be equal to 775,000 divided by 1.854, which will give us 775 divided by 1.854 gives us 42%. Then for the total assets shall be 100%, because it's the total assets divided by the total assets, which is equal to 1854 divided by 1854. That is still the base item, which is still the base item. The base item for the balance sheet is the total assets. So the same shall apply even for the liabilities side. So for instance, for the current liabilities, The ratio shall be equal to the current liability, the accounts payable, for instance, that we have here, divided by the total assets. So for instance, yeah, is 377 divided by 1.854. So expressed as a percentage of the total assets like that. And we can do the same for all the other years. Yeah. So, and be able to identify the trend. Yeah. So you can be able to tell how the business has been performing by doing a common sense financial statement. So you can be able to tell how it has been performing over time. And you can also compare its performance with other companies, maybe in the industry or competing companies, or even companies in the entire economy or the country. So and with that, ladies and gentlemen, we have the common sense financial statements. It's a quite easy topic. So thank you for your attention. May God bless you.